Recording. There we go. Now I've got it started. Well, thank you. So I'm Rod Crandall. You got George Steele. He says he's Nathan Berglund here because Nathan owns our firm, so he's using his account. We're trying to figure that out. But he's George.
Self-promoting.
And I'm Rod, and we're very tickled to be able to potentially support you. Very thankful to Lisa and Jeff for the opportunity to present to you guys. And this is our second monthly coaching call. We call it a Coach's Corner. And what you can expect from us is we're trying to help you have better conversations effectively. At the end of the day, it's really about the conversations we have and having the right conversations with the right kind of person. And, you know, overcoming objections is something that is old school sales. And that's not really where I'm coming from. Overcoming objections is about conversations. And if you're going to start talking about insurance, you're going to start hearing some of these things. And we need to be able to understand how we can appropriately talk about it and position the opportunities that we have for our clients. And if we're not using the right language and we're just talking about that dirty insurance stuff that nobody wants or needs and it costs too much, we're not going to really be able to help our clients as much as we could to reach their goals. The real key is the financial plan, in my opinion. That drives everything. If we have the appropriate financial plan, then we can make all of our recommendations consistent with that financial plan, and we can effectively custom design insurance solutions for our clients as we do so. So I have prepared remarks, but if you guys have questions or comments or concerns, I literally want to be interrupted. I'm here for you. So if you have something, a comment or a question, please just unmute yourself if you aren't already and just jump right on. Okay, we will have time for bona fide questions and answers later if we need to, but I really would like you guys to interrupt me because this is for you. So with that, let's get started a little bit. Talked a little bit about the plan today. You know, who's USAdvisors? Well, on its face, we're a brokerage firm, right? Meaning that we can bring to you fixed annuities. We can bring to you life insurance, both fixed, index, and whole life. I guess I should try to mute everyone. Let me see about doing that real quick. All right, beautiful. Appreciate that. So we can bring you fixed and indexed life insurance, disability, long-term care. So on its face, we're a brokerage firm. We have over 40 companies, pushing 50 different companies that we represent. But really, the reason why Jeff and Lisa have brought us in here, if I can be so bold, is not because we can bring you products. You can get products anywhere. By the way, we are on the Securities America approved list. So we're one of only 4 brokerage firms that you can work with at Securities America and effectively get production credit on their grid without having to put your commissions through the grid. And so on its basis, that's what we are. But what we really do is we work with wealth advisors that generally don't hold themselves out as insurance specialists. So we have very few sort of life insurance agents that we support. Almost all of our advisors are tied with broker dealers or RIA firms and are conducting some version of financial planning. And so it's our intention to really sell, if you will, the intentional integration of insurance. And that's part of why we do these coaching calls once a month about conversations. Who do we talk to and what do we talk to them about? So you're going to hear a lot of that from us. We only generally share product as it relates to our case studies, the clients that we look to help. What did we implement and why? So you're not going to be blasted from us with product. You're going to be hopefully wanting to engage with us to have better conversations once again. And what we really need for our clients is to get consideration. And in order to have consideration, we have to have the right kind of conversation and we have to educate our clients. And a lot of times that's not happening because either the advisor or the client don't want to talk about that insurance stuff. And I get that. And of course, it's not what the insurance is, it's what the insurance does. So people don't like what the insurance is because they got to underwrite me, they're going to pick on me, they're going to charge me, I'm going to have to pay that premium, but they sure do like what it does. And what it does is completes financial plans, it creates legacies, it creates liquidity, it does different things. And so we need to be more intentional on how we're having these conversations. And so I'm hoping that you guys will be able to glean a few things today about overcoming objections. But before we do it, just a little bit about me. I've been in business for 20 years. I've been working with wealth advisors for the past 15 years in their practices. So I have personally worked with over 200 advisors on a point of assistance basis with their clients. And so many advisors choose to make me a part of their team, either on a systematic basis or certainly maybe when they get involved in maybe more complicated type cases. And I quite literally become part of their team and do joint work with them. Now, you're not obligated by any stretch to do joint work with me. To the extent that you want to, I'm available. I'm also serving hopefully as your trainer and coach to try to understand where do these opportunities exist. Now you have George next to me on your screen who's labeled Nathan Berglund. And George is our internal marketer, and he's really good at supporting the case design side of things. Okay, one of the good things about having 40 or 50 companies is that we can look at our clients and say, we can bring you the best in breed. And that's absolutely true. We have the products. The downside is, how do you keep a handle on 40 companies and 100 of products? And as soon as you have the handle, they change on you and they leapfrog each other. And so really being able to understand where the sweet spots are, not only the sweet spots in design, but in underwriting, and then how we design cases. And so George is crucial for our team and will be very crucial for you. Even if you work jointly with me, George would be supporting us behind the scenes. What I want you to hear is you have the opportunity to write business yourself, just like you always have, take all of the commission, and generally speaking, George would be your point person to help you with that. Or you can say, you know what, I don't want to do it, I don't feel comfortable doing it, or I'd rather have you do it, Rod, and then I can drive that for you. And you don't have to declare that. You can declare it on a case-by-case basis. And it really depends how you want to be supported. We really believe, and I certainly believe in the platinum rule, which is to the extent that we can understand and meet your needs, then my needs are met. And so if we don't give you what you need, then we can't get what we need. And so hopefully you'll understand that we really care. And that's important in this business because anyone who's ever written any insurance knows that the pain exists when the client says yes and we get into the underwriting process. And it can be clunky and it can be painful and it can actually be damaging to relationships if we aren't paying attention. And so I'd like to tell you that when you do business with us, there's going to be no issues whatsoever, but that's just not true. That's not the business we're in. What I can promise you is every single person on my staff, and George and I in particular, care dramatically. And when that issue happens, we're all over it and we're very solution oriented and we're very expectation oriented. And that's a key in underwriting. If you aren't setting up appropriate expectations, you're effectively just asking for your client to be upset with you. And my experience is a lot of advisors say, well, I don't even want to go there then. And then if we don't go there, then what happens? Well, do our clients really get the best advice possible? Do they really get a comprehensive and complete financial plan? Do we open ourselves up to competition because somebody else brought it to them? Right? If we're doing the right job, what we end up doing is we do a much better job for the clients. We drive additional revenue to our practices that didn't already exist. A number of the advisors I've worked with, we've found 5, 10, even 20, or sometimes higher % of gross dealer concession in insurance revenue just by paying attention. And by the way, we usually don't have to go out and get new clients to do this. We already have the clients that come into our office. And if we can just understand how to have a better conversation with them, we can lead them to better outcomes. And that also protects our AUM, especially on the long-term care side. Yeah, I believe that long-term care planning is the single most important planning that we do. And the reason for that, I believe, is that the vast majority of our clients are going to have a need for long-term care in some form or fashion, and it's very expensive. So I ask clients, and I would ask you, what's the effect of a double dipping onto your retirement portfolio if one of you needs care, right? And so we can run what-if scenarios. It's all back to the plan. All back to the plan. Insurance just potentially funds the plan, okay? So with that, let's get into some of these objections. This one's one of my favorite, and I've heard it so many times, and I wonder if any of you guys have, that my wife's gonna remarry. I don't need that insurance stuff because my wife's gonna remarry. And by the way, it's always the gentleman who says his wife's gonna remarry. It's almost never the woman who says the husband's gonna remarry. That's a straw man argument in my opinion. And I don't like it when a gentleman says that to me. One of the number one things that I do is I try to make sure that both spouses are in these planning meetings. It's not that I won't meet just with a single spouse, but I try to do everything I can not to, especially if that's the gentleman. And if I can be so bold, I think sometimes the gentlemen aren't really that emotionally intelligent sometimes, and they'll say things like this. And if he's going to say things like this, I want him to say this with his wife next to him, right? Because it may be true that she's going to remarry, but is that the plan that you really want? Is that the plan that you wish to execute, right? And so a lot of people will say a lot of things to get out of the insurance conversation. And if we want to lead them to do what's in their best interest, then we need to be able to be prepared if something like that happens. Okay, so she might remarry, but how many years of cushion would you like to provide them? And that's something that I would ask them. And I don't generally go into how cheap is term insurance, but I do with something like this, because this guy's trying to blow me off. And he's trying to blow off the entire planning process. And so I want to try to get him back on track by asking him what kind of plan he wants with his wife there. But if I can't get that, then I'll ask, are you aware how cheap term insurance is? And by the way, advisors out of role play, are you aware of how cheap term insurance is? I had a guy that I used to work with who said that term insurance wasn't free, but you could see free from where you're standing. And it is, especially for a lot of our clients that really need a couple $1 million of insurance, or the 40-year-old who has a couple of kids. If you're 40 years old, you can buy $1 million of 20-year term for $50 a month. What is that family spending $50 a month on? That's what, a third of their cable bill probably. That's 1 week worth of Uber Eat fees. I mean, what are we talking about? I'm not trying to be too slick of a salesman, but what are we talking about here? We're talking about $50 a month. We're talking about $100 a month. Why on earth would we put our families in a position of weakness for a dollar amount that low? All right. So I hope you take that for how I meant it. And I generally don't go right into cost. In fact, you stay away from costs because it's worth it, because we care about our wives. Right? I don't have multiple wives, right? Just one. But I care about her. And you know what I care about? I care about the fact that if I die or become disabled, that she's going to be able to stay in the house. That's in fact what I promised her. I didn't promise her she was going to get a huge payday if I died. I promised her she gets to stay in the house and maintain her lifestyle if I die or become disabled. And so insurance helps me fund that promise to my wife. And so what promises are we making to our spouses, and are we asking our clients what promises they're making? And that's my point about making sure they're both in the meeting as well. Insurance is too expensive. I bet you guys have this one. I have this one. It's too expensive. It always is. Always is. Doesn't matter how much it costs. Even my previous example, it's always too much. Okay, so I get that. Listen, I agree. It is expensive, especially if you're looking at what it is. But let's make sure we know what it does. So now we're into the financial plan. This makes sure that whether you live, die, or become disabled, that effectively your financial plan is going to come to fruition. And we've proven that through our financial planning modeling and our what-if scenarios. Okay. I often ask, what job would you rather have? I learned that with disability insurance. Okay, so you have $100,000 of income as long as you're healthy. But if you become disabled, your income goes to zero. Okay, so I'll give you that job. I'll give you 2 job offers. Job A, $100,000 if you're healthy, or 0 if you become disabled. Or job B will pay you $97,000 a year as long as you're healthy and working, or will pay you $60,000 a year if you become disabled. Well, which job would you rather take, Mr. Advisor? Right, I would definitely take job B. Well, job B is taking $3,000, too much premium for disability insurance, too much. $3,000 is too much. Until I ask, well, is it too much? Because what job would you have? Do you want to self-insure that risk and keep that? Or are you okay with $97,000 and create $60,000 if you become disabled? And by the way, that $3,000 is 3%. So recommending and positioning insurance as a percentage of income or percentage of net worth becomes very important for what we're talking about. Because it's too expensive out of context, but in context, is $3,000 too much to make sure your plan runs? And now people understand that a little bit differently. So I would suggest again that you use percentages of income and percentages of assets. Okay. Well, I can wait till next year. There's no rush here, Rod. I want to give it some thought. I'll just wait till next year. I'm getting that promotion. We're moving into that new house. There's always something going on that the planning can get kicked down kicked down the lane. And first of all, I realize that, you know what, things really do happen, and timing is everything. So I agree, you know what, timing is everything. What I will tell you is that generally kicking the can down the road is maybe the only thing that I push against. So we don't know each other well, you know, advisors and me, but over time you'll see that I don't really believe in pushing. I don't really believe in overselling. I believe in educating. And one of the only things that I really push against is this idea that we're going to address it in the future. There is very few times where addressing something in the future is going to be more advantageous relative to insurance than today. And that's really for two reasons, and I'm sure you know both of them. One is that health is precious, and all things being equal, I'm in better health today than I'll likely be 1 year from now. And if my health changes, it might preclude me from being able to do this kind of planning at all. And you've done this for long enough. If you have, and I certainly have, you get surprised. You think the person is fine and they think they're fine. And then we go into underwriting and something showed up and now we can't get them coverage. And those are bad days for my practice because all I really want to do is help people and make money. That's really all I want to do. And so relative to insurance, helping them is helping them discover what their need is, educating them on their options, and helping motivate them to take action. And now I've helped you do that. And then how do I get paid? I get paid by putting a policy in force. Well, if I go through that whole process and we can't get a policy in force because of a health concern, how much have I helped that individual and how much have I earned? So those are the worst days in my insurance career when my clients get declined. Now, by the way, as an aside, we do everything we can to make sure they're not declined. We need to pay attention up front and do a lot of field underwriting and understand better about their health. We have a lot of mechanisms at USAdvisors to be able to pre-screen that health. We can go directly to companies in an informal process and say, I've got a guy or a gal and here's what I'm dealing with. How would you treat them? We also have access to an underwriter on our staff that we can go to and say, okay, we got a tricky one. What carriers would you look at here? Can we maybe even put together a cover letter that explains what's going on? And it's really important to address those things before just going into underwriting. Okay. And then there's the last question again. Are you aware of how cheap term insurance is? Because a lot of times this is about dollars. It's about dollars, and I think it's going to cost more than it really is. Okay. And so I do ask that question. You also get, hey, I got a lower quote somewhere else. Well, actually, you know, I saw these lower prices, and this happens quite a bit, you know. And the answer, of course, is that, well, you can quote anything, and it's true. And insurance isn't pass or fail. And a lot of people don't really understand that until you explain it. It's not really pass or fail, it's pass and slot. And so depending where you are, you might be slotted. And so the quote that you received, where were you slotted? And more than any time that this happens, it's almost always at a super preferred or preferred best rate. Well, as best I can tell, about 5% of people get that rate. Very hard to get a super preferred rate. Okay. And again, indicating that we do have an in-house underwriter, because we're not just trying to quote, what we're trying to do is match you with the right company and product. Okay, while the companies pay us, we're really working for you, the advisor, to figure out, or the client, to figure out what you need and what company is going to be able to treat you most favorably based on what we're trying to accomplish. Okay. When I go into underwriting, my closing line is always, you know, before we make a final decision, let's solidify the pricing structure. So we walk through the whole thing and they say yes. We go, but we still need to qualify for it. So let's go solidify the pricing structure through the underwriting process and be sure we can get what we want and that we can get it at the price that we want. And so that's how I generally deal with that. Okay. How about just send me some information, you know, just quote me. I would say, generally speaking, you never want to quote just in general. If somebody wants a quote, I do everything I can to not just quote. Because if you're sending a quote, what they're really looking for is the lowest number on a page, which I think is why in competitive situations, people show the preferred best teaser rate because it's a lower quote. And when you're dealing with quotes, the quote I want is the lowest number. That's what I want. But I don't have context. I don't have context. So first thing I would say is try not to quote. I want to have a conversation first. I want to quote second. But you want me to send you something, I don't even know what to send you. I mean, what do you want me to send you? I work with 50 companies. Again, I believe these are our clients trying to blow us off effectively because they don't want to say no. They want to talk later. They want some information to review. And I think it's a straw man's argument. Okay? So I indicate that it really isn't about the quote. It's about the financial plan and how we can custom design insurance to fund that plan. And so what I'd like to do is not start with quotes. I'd like to take a step back, and I'd like to understand more about what you're trying to accomplish and what your risk tolerance is and the planning that you've already done and what your experience has been overall, right? And so again, a lot of this is getting back into a planning conversation. All of it's back into a planning conversation. Understand you don't love insurance, but you might love what it does for you. Let's have a planning conversation. What could go wrong? Okay. I need to do some research. Well, you absolutely should. There's absolutely no reason why you shouldn't do that. Now, by the way, while you're thinking about the company and the structure we're putting together, maybe we ought to solidify the pricing structure and get into underwriting and let them think about you at the same time you're thinking about them. Generally, underwriting takes 30, 60, 90 days and sometimes more. And so if you're not 100% sure, you can continue to give that thought. Why don't we get the ball rolling so that they're thinking of you at the same time? Okay. Once again, we want to solidify that pricing structure before we even can formalize our recommendation. If for some reason the cost comes back 10 times higher than I quoted you, well, then I may no longer stand behind this recommendation. Right? And then understanding that there's a lot of blanket advice being given out there. I know on the Wealth Advisors side, you know, Susie Orman shows up and a couple others, well, in insurance too. And they're given very blanket advice, some, if not most of which is pretty good advice in my opinion. But you're not just the general public, are you? Your situation might be a little bit different than somebody else's. And the real answer to every financial planning question is it depends. And it depends on what? Depends on your experience and your risk tolerance and what you've already put together in your health, right? So it's back to having a better conversation, better conversation, better conversation. Okay. I'm going to buy term and invest the rest. I will bet you there's advisors listening to this call that believe that themselves, that we shouldn't accumulate money inside of a permanent insurance contract. I should buy term and invest the difference. And what I would tell you is I don't really have a real problem with that. And in fact, depending on what happens, I think it's absolutely possible that you can outperform that. I completely get that. I do believe it's a straw man's argument because they want quotes, and the permanent insurance quote is a lot higher than the term quote, and they just want the lowest quote. So they say, I want the lowest quote, and I'm going to invest the difference. When in reality, they spend the difference on their Uber Eats and other things. So I think that it's just straw man. They're saying things because they don't want to talk about it. Now, by the way, as an aside, the reason I work with Wealth Advisors is because you have high trust relationships with your clients. That's why I work with Wealth Advisors. Because if you're going to talk insurance, there's going to be a lot of distrust. Now, maybe that's my belief and maybe I'm projecting. I believe there's a lot of distrust in insurance salespeople, insurance companies, and insurance products. And I think for pretty good reason there's distrust. I also happen to believe that my average advisor has a very high trust relationship with their client. And if they have a high trust relationship with the client and they know what their situation looks like doing financial planning, that is the perfect way to have a conversation about insurance. And it's way better than just letting some random insurance agent talk to your client out of context. And that random insurance agent might very well have an investment license. Certainly if they're Northwestern Mutual, they almost certainly do. And they're really good at getting the insurance first and then pulling the assets second. And they do that with language like, well, wait a minute, your CFP never brought this up before? You've been working with them for 17 years, they never brought this up? That's interesting, right? So that does happen out there. And I don't want that to happen to you guys. Let's help our clients. Let's drive more revenue. Let's protect our AUM. Right? Furthermore, if you put together a life insurance contract for accumulation purposes, which in our next coaching call, we're going to be talking about how do we design insurance to focus on death benefit and how do we design it to focus on cash value. So we're going to go in deep next month on this. But if you properly structure these accumulation contracts, you can get the cost of insurance under 1%, and in some cases, you can get down to 50 bips a year if you get out 20 years. And so if you're buying an asset class that is tax-free, It's tax deferred, and we can take tax-free distributions, and we can get the costs down to 1% or less annually, all of the costs. That can be a very efficient asset, especially compared to taxes otherwise. And so I would suggest that people who want to buy term and invest the difference need to be educated on how a properly designed insurance contract can accumulate and be efficient for them. And if they get educated on that, then they can consider whether they really want it. And if they consider if they really want it, in my personal practice working with wealth advisors, our implementation rate is over 80%. Clients are taking our recommendations. And they're taking our recommendations because the financial plan's in place. They have a high trust relationship with you. And hopefully I helped to put things in context for them on how they ought to view these things. The big trick to all of this is if we knew exactly what was going to happen, we would know exactly what to do. So when you're dealing with insurance planning at a very high level, the question number one is, do I have a risk? If you do not have a risk, or you feel you do not have a risk, there is no conversation to be had. But if I do have a risk, then the next question is, well, how big is my risk? Well, that 40-year-old who's earning 100 grand a year and has 3 kids at home, that risk is pretty high if he passes away because he's a big money machine for his family. Okay? And so how big is that risk? Well, it's pretty big. Then the next question is, how do you feel about it? I don't care if she's going to remarry. Okay, well, if he doesn't care because she's going to remarry, there's nothing for us to do. But if we're going to be a good advisor for them, we have to try to shake him loose from that idea, which is why I'm even talking about objections. Okay? So if I have a risk, how big is it? Do I care about the risk? If we can get clients to understand their risk and quantify how big it is and ask them how much they care about this, then all we have to do is now we just have to educate them on how we can minimize, reduce, or eliminate that risk. And if we can do that for 3% of your income, maybe that makes sense. Would you rather keep 100% of your income and 100% of your risk? Or would you rather reposition 3% of your income to minimize this risk to the insurance company? All right, so that's the kind of context we're dealing with. I don't love paying my insurance premiums either, but I do it. Why? Because I told you why. Because I promised my wife. But there's another reason I do it. I do it because I want tax-free distribution in retirement for myself, and I don't qualify for a Roth IRA. So I do it out of love because I want to fulfill my promises to my wife, and then I do it out of math because I have a small old Roth IRA and it's not going to be big enough, and most of my money is going to be in qualified accounts, and I happen to believe taxes are going to be higher in 20 years from now when I go to take money out of that. I'm going to be 44 this year. Okay. Have you guys ever heard this one? This one's tricky. I've heard this 3 or 4 times. Looks like Nancy might have heard this one. Have you heard it?
I had told my kids we've vacationed in Oregon a lot because that's where some relatives live. And I always say, you know the way. Yeah. You know what you're supposed to do. You know the way. Yeah. No, so yeah, not only have I heard this, I've actually said this.
Yeah, no, I get it. I know there's some callers. So this is, I will end my life if I ever need long-term care. Just take me behind the barn, right? Well, my opinion is 2 things are happening here. Number one, they're trying to blow us off again. That is part of it. But the other part is this is rooted in love, I think. They go, hey man, if I ever get like that, I don't want to be a burden, you know? And so I understand that. And this one's a tricky one. It's tricky. Now, first of all, I want to make sure that this is the guy who usually says it still. I want to make sure both spouses are in the meeting, okay? Because if he says that and she accepts it, I mean, it's their plan. What can I say? But I don't want him to say it without her in there. Now, I understand where you're coming from, and I have heard that before. Okay. Probably isn't the best plan, though, right? I mean, is that the plan that you want? So I really like just call them out because it's obviously it's not a plan. Now, by the way, you have to be of sound mind to be able to take your own life to begin with, right? So, you know, I have a cognitive impairment. You're not even going to have that option. Now, I can't recall, honestly, whether I got the 3 or 4 people who said that, whether they implemented for me or not. It's been a long time since that's happened. But what I will tell you is many times I have pulled out a waiver for long-term care. when people have said, you know what, I don't want it, I don't need it, I'm not going to buy it. I say, will you do me a favor and will you sign a waiver for me that I can put in my file that indicates that we did have this conversation, I did recommend that you put protection in place, and you decided not to put it in place. Okay. How well received do you suppose that waiver is by the clients? Because it's not that well received. Here's what my experience has been. They do not want to sign that waiver. Okay. My belief is that clients don't want to say no to us, so they say maybe. Talk to me in a year, send me something, show me a quote. They don't want to say no. So they put us in the maybe bucket. And in the maybe bucket, they're safe, but we haven't been able to help them. We haven't been able to make any money. So they're safe in the maybe bucket. Well, when I ask them to sign the waiver, I'm asking them to put themselves in the no bucket, and they don't want to do it. Now, I can tell you that I have had people say yes because they didn't want to sign that waiver. Okay. And it's psychological. It's maybe a little bit tricky. I'm not trying to trick our clients, but I'm trying to tell them this is important. And you know what else I'm trying to do? I'm not a scare tactic person. But to think that advisors aren't going to get sued when $800,000 comes out of the retirement account for one spouse's care, and that advisor is a CFP, and that advisor has never talked about long-term care to that client, I believe that we're going to get in trouble. And again, I'm an optimist. Okay, but if we can document in our notes and we can show that we've brought these things, and certainly a waiver makes that gives us a lot of protection. But again, our job is to motivate our clients to operate in their own best interest. And their own best interest is they need to consider this kind of protection, because what's the impact on the retirement account if they have to double dip for the long-term care and their living expenses? If you got a client who wants $80,000 a year and you got a beautiful plan for them, you know, they got some Social Security, a small pension, and the portfolio. What's the what if scenario if I have to double dip another 80,000? That can really crush our plans, right? So I talk about long-term care insurance as retirement portfolio protection, right? Because that's what it is. If you or your clients need long-term care, you're going to get the care you need. And if you get the care you need, it's going to cost something. And if it costs something, you're going to pay for it. And if you're going to pay for it, that's the least effective way to pay for your care is your own money, dollar for dollar. And what if I have to advance it from a qualified account? Now I have to pay taxes in order to get my spendable dollar. What if I'm doing that in a down market? Now I'm redeeming shares. Now I'm sounding like a negative Nelly. Okay, I'm not. But this is the reality, and we need to be educated on that. We need to ask them, are you aware that you have a risk of that double dipping? Do you know how big that risk might be? Let's model a what if scenario. Do you care about that risk? Would you like to be educated on how we can minimize or eliminate that risk? If we can do those things, then we can quote. And what I hope you're hearing from me is that people are quoting and they're losing. You quote, you lose, in my opinion. Okay? You quote, you lose. There's a 10% chance they're going to implement. There's a 100% chance they're going to implement something less than they need. Don't quote. Have a conversation, bring the quotes in later. Okay, that's my real belief and my advice. How about this one? Traditional long-term care insurance is garbage and my rates are going to continue to go up. I work with a lot of advisors. I'll bet you anecdotally 50% of them are uncomfortable positioning traditional long-term care and won't place it at all. Here's my view. I'm one guy. My view, first of all, I respect that dramatically. If you as the advisor don't believe in it, you can't put your clients in something you don't believe in. So I respect that. Okay? I happen to believe in it. Now, I also believe in hybrids. Okay? Here's the thing about traditional long-term care, in my opinion, a few things. Well, first of all, the biggest issue is that the insurance companies won't guarantee that they won't raise rates, right? And so what that means, in my opinion, is that they are guaranteeing you they will raise rates. So right away, we're like, I don't want my rates raised. And I get it, I don't either. Okay. The second issue is, hey, I might pay this for 30 years and I didn't need care, which is what I want, and now the insurance company's kept all my money. Now, I believe in traditional long-term care for a few reasons. First of all, if we knew what was going to happen and we knew that your client was going to need long-term care, buying traditional long-term care would be the best decision. It is mathematically the most efficient way to pay for care is to buy traditional long-term care. Absolutely. Okay, it can be proven any way that you want. The problem, of course, with that is that it's the least effective way if I don't need care. I pay for 30 years, take rate increases, they keep my money. Well, that's why hybrid policies exist. By the way, in 2 months from now, we're going to be talking about retirement portfolio protection utilizing long-term care structures. I have something I call a 3-lane highway, where there's different structures that we can use depending upon what we're looking to accomplish and where the money's coming from. Are we repositioning dollars? Are those dollars going to be qualified or non-qualified dollars? Are those dollars in an investment account today, or are they in the bank? There's different structures and strategies and sweet spots for these things. Okay. But I believe in this because the biggest pricing errors have been fixed. Okay, they borrowed a lapse rate from life insurance, and life insurance, you have 9% of people lapse their contract every single year. So if you go out 10 years and in year one you had 100 contracts with life insurance, by the time you're at the 10th year, you have like 67 of the 100 contracts still in force because people lapse their contracts. Well, old versions of long-term care took that lapse rate and applied it to long-term care and assumed 9% of people would lapse their contracts. Well, what they found was that less than 1% of people lapse their contracts. So if 1% drop instead of 9%, you go out 10 years, the insurance companies were expecting 67 insureds. They have over 90 that are still insured. And so that's been fixed. So that's inside here. If you haven't quoted traditional long-term care recently, you might be surprised how expensive it is relative to what it used to cost. Okay. So many times I get telephone calls with clients getting increases in long-term care. And they say, what should we do? And we look at the numbers quickly and we say, you should take the increase. Because if you try to buy a new policy, a lot of times the new policy is double, triple, or even quadruple what the old policy premium was. So I do think that they're a lot safer today. So the biggest one was that lapse. The second one is the interest rate environment. Well, insurance companies now know what kind of interest rate environment they're in, and it's priced in here too, and they can't get much lower. And I don't know if you guys have thought much about insurance companies specific to low interest rate environments, but it wreaks havoc on their ability to do business. Most of the companies that we work with might have 50 billion or 100 billion set aside in reserves to pay claims. And with the interest rates that we have, that profit center for them is much smaller. And so it affects all kinds of things like pricing. It affects the caps that can be given in indexed products. It affects underwriting. And so the insurance industry overall is making a lot of changes right now. We're seeing a lot of repricing across the board, and guarantees are being minimized and in some cases going away. Right? So I would suggest to you that don't throw away the traditional long-term care. And as you'll hear from me in 2 months when I talk about the long-term care, I think there's real value in bringing 2 or 3 solutions to a client, because what I've found is that clients very rarely feel like they know what to do. I really want to take action on that. I find that very infrequently. But what I find very frequently is they know what they don't want to do. And so if I give them 3 options for long-term care, what I find is very quickly they can tell me the one option they absolutely do not like. Let's just cross that off. Beautiful. Well, I love that because I want to help them through the conversation and through the process. I want to help them make a good decision. And so when they can hone down 3 options to 2, they've made a decision. They don't like that. Now we have momentum, and now we can drill in, right? And that also keeps us from having to have a big pile of illustrations all across the board for lanes. I call them lanes that they don't like. So I start with an executive summary, which I'll share with you. And then I have them say no, and then I have them drill down, and then we go into illustrations to tweak our benefits. And I found that to be very, very successful because a lot of people get very confused. I've had a couple of widows that have been crying in the same wealth advisor's office that they talked to 3 or 4 long-term care people and they don't know what to do. And they both brought in big stacks. And so going through a better conversation, and by the way, pulling up the financial plan right in the corner is huge. Can I afford this? They look at the advisor, go, Frank was the advisor. Can I afford this? And he goes, yeah, look, I ran this, and pulls it right back up here. How relieved those 2 widows were. They were both widows. In my opinion, they were desperate to buy it. They really wanted to buy it, but they were scared because they didn't want to make a bad decision. So they talked to insurance agents and got really confused. So they went into their wealth advisor's office and said, what can you make of all this? And the wealth advisor said, bring Rod in here. We'll have a better conversation and we'll pull up your plan. And then we finally had success where 3 or 4 other agents didn't. And most importantly, the clients themselves were very upset. They were frustrated and they just could not get it. So in any event, that's my 2 cents. I'm curious if there's any objections that are out there, Nancy or Christine or anybody else that you guys have that you either are successful at overcoming or you want some advice on how to overcome. Is there any objections that you're running into that you guys want to talk about?
You know, I was thinking back to the Pleistocene era when I used to also hear that from people. You'd be surprised, the men that would say, my wife will get remarried. And now what I notice, since fast forward into the future and I'm miraculously old, I see that the men, should the woman die, get remarried is faster than I can tell you. And then the women don't usually. So that's interesting to me that you said the men say that the women will get remarried. Do you have any idea where does that come from? Because in reality, it plays out the other way.
Yeah, and you're right. And thank you. And I found the exact same thing. I'll tell you what my impression is. My impression is, first and foremost, they're trying to blow it off, okay? Because they don't want to take that responsibility. She'll just get remarried. She's going to be fine. See, she's going to be fine, so I don't have to take action because she's going to be fine. I think that that's where that comes from, okay? And it's really consequence management as well. See, that's the thing, is what are the consequences of not having plans in place, right? And I don't know, that's my feeling. Do you have a sense of where that comes from? Because you're right, the guys run out and they get remarried right away, and the women go, hey, you know what? I'm going to take care of myself.
No, I honestly was interested in what you had to say from your perspective. That's. But do you have more people that have more questions? Because I have more questions.
Well, you go ahead and shoot. If there is more people that have questions, we'll have them come right on and ask them.
You know, I got to thinking about a situation I had where we tried twice to get the same couple long-term care insurance, the type that you fund it, you put money in like a life insurance program and then have the benefit available. And they were turned down for health reasons, which the insurance companies would never reveal. They didn't look at all unhealthy, particularly here in the Midwest, height, weight-wise, they would have been first class. So clearly there was something that wasn't revealed to me. I had a very cursory questionnaire for them, and then anything in depth, they were turned down twice. But later they went and bought traditional, where they were approved. So I wonder, in your experience, do you feel that there's a lessening of requirements in the traditional compared to where you fund?
No, I don't think so. Here's what I think. I mean, first of all, a couple things. Every time I've had a client got declined, I've gotten that insurance company to write a letter to the insured indicating the reason for it. So. Oh
yeah, we did get letters, but they would never reveal.
Really interesting. Okay. So that would be the first level. Then I would ask the client, you know, I hate to be so direct, but I can't help you without knowing what the issue is. So I would try to pry. But now I'll answer your question. I'm guessing, but here's the deal. When you're dealing with traditional long-term care, you're dealing with a morbidity risk. So the morbidity risk means the likelihood that I'll become disabled. When you're dealing in life insurance, you're underwriting a mortality risk, which is the likelihood I'll die prematurely. When you are underwriting a life insurance and long-term care together, they're literally underwriting you distinctly different and placing both ratings on top of each other. So based on what you told me, I believe that your clients have a mortality risk, not necessarily a morbidity risk. I'm guessing because I don't know what we're dealing with, but I think that's what you're dealing with.
And while I could have never said it that well, that was the perception I came away with as well.
And I talk to clients about that and they appreciate it. And it may seem a little rude, but a traditional long-term care underwriter effectively likes it if they think your life is going to be short, and vice versa, right? So that's where you'll have, it depends what they're underwriting for. And that's really what you want to describe. And that's very important in the pre-screen, because that might tell you right away, well, you know what, you have a pacemaker, for example. Well, we're in big trouble here for life insurance, right? But if something's likely to kill me, then it's less likely to disable me. And what risk does the insurance company have? Insurance companies are professional risk managers and professional money managers. And I make sure that advisors and clients really understand that. And that's in part why we can put together really strong guarantees. I love guarantees from professional money managers. I think it allows us to take more risk in our portfolios as well. So there's multi-layers. Other comments or questions? Nancy?
I have more.
We're here for you.
I really am Columbo. Okay, so I am interested in that hybrid when we get there down the road a piece.
Okay.
And but one of the things that I tend to well, let's stay in long-term care here for a second. Are the long-term care policies that we fund, that are life insurance policies that we use for long-term care, are we still funding those 10 pay, or is it always a lump sum?
No, there's a number of different options. So you can do lump sum. You can do lump sum with non-qualified dollars, or you can do lump sum with qualified dollars. You can also do 10 pays with many or most of our structures. And there's also structures that you could do all pays. So you could buy like a $200,000 guaranteed universal life policy with a 2% long-term care rider that allows you to grab $4,000 a month for long-term care for 50 months. 4,000 a month times 50 months is 200,000. So effectively you have a $200,000 asset that's either going to pay for life insurance, or we're going to advance our death benefit at $4,000 a month, or a combination thereof. And that type of structure can be funded on a single lump sum, a 10 pay basis, or an all pay basis, really almost any basis. I call it mortgaging. You want to take a 15-year mortgage? Many of our designs will allow for that.
Right, I'll just add to that will vary by age and by carrier. And so Nationwide, for example, in the hybrid space, has a pay to 95, or now you can't qualify for that payment plan if it's like 75 or older, things like that. But there are quite a range of pay plans, recognizing your biggest bang for the buck and asset linked is always going to be a lump sum, but recognize budget in between.
Yep, that's exactly right. And that's why, especially for all things insurance, but long-term care in particular, we'll have advisors reach out to us and they want to get a quote for John and Sally. Again, you know how I feel about quoting. Go, okay, well, I'll give you a quote, but you've only given us 1% of the information, right? What health class do you want them run in? Are we going to use qualified or non-qualified dollars? Are you looking for a lump sum structure, a 10 pay structure, or a forever structure? Are you taking any money from old contracts via 1035 exchange? Do you have a budget that you want me to run this quote at? So, do you have benefits that you're trying to target? See, I just rattled off 10 questions that weren't answered by saying I want a quote. And so that's part of, again, that conversation. Let's have a conversation about the client. Where is their money? Are they more likely to be able to take an expense in retirement and continue to pay that each year? Or are they sitting with $400,000 in a bank account earning 1%? We could reposition 100,000 of that, right? Yeah. You're laughing.
Sounds like you've been to Nebraska.
Yeah. Yes.
That's how we do. That's how we do. Okay, I do have one more question, but I think I've asked it before, and George sent me some information on it. So let me go back and review what he sent, which I did read and probably forgot. Okay. So let's not waste everyone else's time while I rehash my already asked question.
It's no worries. I mean, that's fine. Christine, you've got something?
I was just going to comment that any question from Nancy is not a waste of time.
Thank you. I was going to say similar, because if you have the question, then other people probably have the question as well. So,
Well, it's a little specific. It's just that I know that state to state farm ground inheritance is very different. And here in Nebraska, I don't always see where life insurance fits nicely. Sometimes you have lineal descendants, sometimes you don't. In Iowa, that's a big deal. I think it's a little bit of a deal here in Nebraska as well. And so I probably have opportunities, but I just don't see them.
okay, makes sense. Well, I would say that big picture, the opportunity might be as simple as you have clients that have wealth that they're going to transfer to future generations. And if you do, that client should consider whether or not the asset class called life insurance should be part of that transfer. And so life insurance as an asset class for distribution or for wealth transfer can be very powerful. You can get guaranteed non-correlated and income tax-free returns at life expectancy in these contracts between 4 and 8%. And so especially just on its face, knowing that we have an asset that's tax-free to our heirs, that's non-correlated to the market could be a reason just to consider it in and of itself. But then when we're talking about estate planning, that can create liquidity. It shows up in cash. How much of your client's assets are just literally in cash? And by the way, if they do have a family farm, is one or two of their kids running it and one isn't? How do we equalize that? So there's an estate equalization piece that can be in place as well. And we're going to talk about that kind of stuff in next month's meeting about effectively positioning for a wealth transfer. And this is very important for large qualified balances today, right? Let's say you have a client with a large qualified balance. Now the non-spousal beneficiaries have to take that over 10 years at the longest. So if I inherit an IRA right now, I'm not going to be mad about it, but this is going to be the worst asset for me to inherit right now. The worst. Okay. So if my parents love me and they know I'm going to inherit this asset, they ought to consider whether or not they should, instead of leaving me a qualified plan, maybe they should leave me some life insurance. I'm not saying they should do that. I'm saying they should consider it. Why? Because I can get a 4, 5, 6, 8% return tax-free in life insurance and life expectancy, and I don't have to pay taxes. Okay. So there's a lot of good reasons to consider it as an asset class. And what you're going to hear me talk about, Nancy, is a lot of people who buy insurance from me do it because they want the insurance, not because they need the insurance. And these aren't people who want quotes. You go, no, wait a minute. The reason I want it is because it's one of the most tax-favored vehicles around. And our best clients are getting crushed with taxes. Income taxes, estate taxes, capital gains taxes. Well, should they consider an asset that they don't have to pay taxes on any of those bases in that asset? I'm not saying everyone needs it. I'm saying if you're paying that many taxes, you should consider whether insurance can be a better vehicle for part of your dollars. So it's an asset class conversation.
You're absolutely right. When the way life insurance assets come to the beneficiary is a thing of beauty. Do you have any trouble insuring the life of even though we're using it for wealth transfer, do you have any trouble insuring the life of the individual who is actually actively doing the farming due to occupation?
Not due to occupation, no. If he has other issues, but no, the occupation itself, I mean, we have no issues with that. And by the way, sometimes you use second to die structures in that spot, right? Because a lot of times you'll have a husband and a wife, and the wife might be a little healthier and a little younger. And so by insuring both of them, we reduce the cost even more so we can get even a better yield, because it's really about our yield. See, everyone's thinking about insurance about what it costs me. That's not what I think about. I think about what does that insurance create? It creates an asset. If it creates an asset, we can tell you how efficient that asset performed. And if we can have an efficient asset performing that's based on the claims paying ability of professional risk managers and professional money managers, I have to consider that sleeve. And what I really believe is a lot of wealth advisors are ignoring the sleeve of insurance as an asset class for a lot of reasons. They don't want to be an insurance person. They don't want to have to run quotes. They don't want to have to go through underwriting. There's a lot of reasons why, but they're ignoring it. but it's a non-correlated income tax-free asset that can be dramatically wonderful for the right kind of client.
Christine, you can call me and ask me a bunch of questions since I took up all the time.
That's quite all right. I'm learning. See, I'm not going to just run into a farmer down the street from my office, but I am learning that this is something unique that I need to consider if I'm ever in that space.
Yeah.
And that's important.
Yeah.
I would actually also like all of you to know that this phone hasn't rung since 1937. But ring since we've been on. I apologize.
That's all good. It's beautiful.
That says business is good.
Yeah. Yeah. So Christine, you hit on again what, as I wrap this up, knowing that we're approaching the top of the hour, what you're going to hear from us again is all about identifying the clients that we need to be talking to. Okay. And so the clients we need to be talking to are those that have kids that are young, that are still trying to complete their plan. We need to be talking to them. We need to be talking about people who are in retirement or approaching retirement about retirement portfolio protection and estate plans. We need to be talking to our business owners about key person and buy-sell planning, right? We need to be talking to our affluent individuals about the cost of taxes to transfer wealth. And so if we can help identify the people that you need to talk to and help you have a better conversation, by doing that, we get the consideration we need from both you, the advisor, and the client so that we can help motivate them to operate in their own best interest. Okay. And by the way, we haven't talked a lot about commissions, and we almost never do, but commissions are very large. We get paid very well to help these clients. I mean, I'm currently working on a number of cases that are north of $40,000 of commission right now. And you know what? We win, but if we make $40,000, I promise you that client has won way more than we've won. Okay, by understanding the math of insurance and how it fits. And so I can all but promise you, everyone that's hearing this, that you have 10 and 20 and 30 and $40,000 cases right inside. And if we can help you figure out who to talk to, and we can help you do that comfortably and not in some weird insurance salesperson way, that's why we're here, and that's what we want to attempt to help you guys with. Okay. All right, any last questions or comments from the two of you?
Thank
Not
you
really,
so
just thank you.
Good.
Yeah.
Well, we appreciate you. These are going to be recorded, and you can reach out to me or George at any time, and that's actually what we would ask. You know, I can effectively say anything to you that I want. We want to be able to have the opportunity to demonstrate that this is how we view things and we can help. And really the only way we can demonstrate that is if we help you with some cases. What we'd like to suggest is that you find 3 cases and maybe 4 cases and be intentional about it. And then you're going to know after 3 or 4 cases whether we're the real deal, whether you're going to like this business, whether there's really any opportunity, or you can do what maybe you've done, and I don't mean to call anyone out, but maybe you do what you did before, which was nothing. If you do nothing, then I have to question how much we're helping our clients. Are we doing the best job? Are we leaving money on the table? Are we opening ourselves up to competition? Are we opening ourselves up to potential litigation? And there's really no reason to do that because we're here to help you, and we're ready to do it. Our next coaching call is March 18th at 1 p.m. And that's where I'm going to be going through, is this life insurance for death benefit or is it for cash value? And I'm going to show a couple of case studies on who we talk to, how we talk to them, and show you some real numbers on how powerful the math can be inside of these insurance contracts. So with that, that's all I've got. I appreciate you all. Stay safe, stay
Thanks for the
warm.
good info.
Thank you.
Appreciate you guys. Have a good one.
Thank you.
Talk to you.
Take care.
Bye.